so much to discuss. Libya, OPEC Plus, the US. We're very happy to have Ole Hansen. He is the head of Commodities Strategy at Saxo Bank. He joins us from Copenhagen in Denmark. Ole, good morning to you. Oh, actually, it's good afternoon over there, but thanks so much for joining us. We appreciate you being with us on the show. When it comes to oil price volatility and what we've seen this past week, do supply and demand fundamentals trump geopolitical flare-ups?
Well, good morning, and thank you very much for inviting me on your show. Yes, it does to a certain extent, but we have seen obviously some attempt to drive prices higher during this year with geopolitical events, but they have had a short-term impact. And what we're seeing now and recently, especially this week, this past couple of weeks with the breakdown, is simply the fact that the demand is too sluggish in order to keep the market supported, especially as supply continues to be quite robust from non-OPEC plus producers. So yeah, a bit of volatility coming back into the market, but we've basically been trading sideways for the best part of 2 years. So at this point in time, there is obviously a risk that we potentially could see prices lower in the short term.
Now, you mentioned non-oil, or rather non-OPEC oil producers. I want to bring in the United States to start there. We had, of course, that big debate. I wanted you to take a listen to what Vice President Harris said about oil production in the United States.
My position is that we have got to invest in diverse sources of energy so we reduce our reliance on foreign oil. We have had the largest increase in domestic oil production in history because of an approach that recognizes that we cannot over-rely on foreign oil.
So, Ole, as far as the U.S. oil production, what do you make of what you've seen there? What does that impact have on shale producers and I guess the average U.S. citizen with where WTI is right now?
Well, first of all, the U.S. consumers are enjoying very cheap prices, lower taxes, obviously compared to where I'm sitting here in Europe. But it's also quite clear that the initiatives that's seen in the past decade has led to this big jump in domestic crude oil production. But I think also the shale patch right now can send a thank you note to OPEC Plus for keeping prices elevated now for the past couple of years. Because OPEC really, it is a predicament for them because they've been cutting production in order to maintain high and stable prices. The only thing they really achieved has been to achieve stable prices, not the high levels that they were probably looking for. And these high prices, or relatively high price we've seen, has invited non-OPEC production to grow quite strongly. And that's really where we are right now, that OPEC Plus will be struggling to add barrels back into the market. Regarding the U.S. production levels, we have seen it plateau this year. I think the growth outlook going forward here is probably fairly limited. We may see a little bit more increase, but overall, I think it's more a question of that investments are now continuously required in order to maintain the current level of production in the coming years. We've even seen the EIA slowly reducing their growth forecast for this and next year. But a sustainable high level is obviously good for the U.S. economy, and it is diversifying their imports and where they source their oil from.
Thanks for that. Okay, so you've mentioned OPEC Plus. They did reverse course on adding 180,000 barrels back to the market in October. They say they're going to delay the move till November. How do you see prices working out to then? Do you think OPEC will stick to that, or will they be forced to change course again a couple months from now?
I think if we stay at these levels, sub 75 in Brent, they will have an issue regarding adding barrels into a market that is clearly not needed. We may also see Libya production come back online before that, hopefully, I would say. So it basically points to OPEC Plus potentially being forced to delay that production increase even more. And you can almost argue in the short term or the medium term, what they need is actually a low price in order to reduce some of that non-OPEC Plus growth. So it really has been a success, the cuts, but probably not as successful as the group had hoped for.
Thanks for mentioning Libya. I did want to get to that. So we've seen the standoff over who controls the central bank. I think it's taken off about 500,000 barrels or more. What do you see if Libya was to come back, if they sort this out? I think it was Sadiq Al-Kabir, the central bank governor, who's in the middle there, speaking to media saying that they could work this out in the future. Does that indeed add to the supply glut if Libya adds those barrels back to the markets?
I think if it happens relatively soon, the time that this oil has been off the market has not really had a significant impact. We failed to rally when the cut was or the embargo or the force majeure was announced, and with that in mind, I think the barrels coming back may have a limited negative impact simply because the timing or the duration of this outage has been relatively small, but a prolonged one may actually add some support to the market. But clearly, from a security and stability perspective, we certainly hope that they can sort out the discrepancies fairly soon.
I do want to get to China, and I'm really dying to hear your thoughts here, being that of how China impacts the markets. We got a lot of data this week. Trade data in August, inflation as well. And I also want to get to, this is the trade numbers. So we see imports falling, further than what the markets were expecting. And also, on the producer side, it seems to still be in deflation territory in China. But I do also want to get to a quote from the CEO of Standard Chartered Bank, who was speaking this week. He was saying that we know that the underlying source of a lot of confidence question in China's property market, and that the property market has not yet completely bottomed out. So it's been a slow grind. So Ole, when you put all this together, how do you see things, weighing on oil markets with where China's economy is?
Well, the increase that has been required from producers around the world in recent decades seems to be fading when it comes to Chinese demand, because Chinese demand growth has really been one of the main drivers for the need to produce extra barrels, and it really seems like that we are grinding to a halt now. And it's not only because the Chinese economy is slowing; it's also simply because they're having a massive move towards electrification, which is reducing the overall demand for not only gasoline but also diesel, as trucks drives on other fuels, and that is part of the story as well. So IEA predicting or saying that the demand growth in China this year has gone down to a trickle, closer to 200,000 barrels a day growth this year compared to 1.3 million last year, is really a sign to the market that the need for adding barrels in the coming years may start to fade as we see this transition towards other fuels, basically reducing the overall need for gasoline and diesel. China is one story, but obviously there are other parts of the world, Africa, India, and so on, where demand is likely to continue to be robust and still rise, and that will probably keep oil demand from falling for a number of years. But generally, it is a situation that the market has to get used to, simply because the strong demand growth that we've seen in recent years seems to be fading.
Thank you so much for the insight there. So I want to get you to a forecast from Citigroup. They say they could see possibly $60, even $50 oil in 2025. I think OPEC and OPEC's moves in the future were part of what they were baking in. I should point out UBS did say I think they said about $70, $80. But for Citigroup's projection, is that an exaggeration? What do you make of that?
Well, banks' analysis of oil prices is changing from one week to the next based on where the spot price is going. So yes, it is likely. But both scenarios are very much likely. It's difficult to predict anything in this market right now. But one would have to say that given the current sluggish demand outlook, there is a downside risk to prices from here, which eventually would be a positive thing because it will curtail some production and eventually help stabilize the market. But we also have to remember that we're just about to face an interest rate cut in the US next week, and that would be followed by a succession of cuts that will support, I would say, emerging market economies who are loaded up with debt in dollars. That would be easier to service. Potentially could also see a softer dollar, which may also help. So it's not all negative. So if we do hit 50s, I think it would be for a very short period of time. We also have to remember that if we look at how speculators are behaving right now, they're holding a record low belief in higher oil prices, and that's always a little bit of a dangerous sign to me. When the market is so one-sided in their belief, then it doesn't take much to turn the boat around. And with that in mind, I think we are the 70 level in Brent crude. I think potentially could be somewhere around a floor for now.
Okay, that's good. That's good to know. Now, there is an article in oilprice.com where it says that low oil prices could lead to a number of non-oil producing nations avoiding recession. So I guess it's two sides of a coin here. What do you make of that assertion?
Well, that's a good assessment, and if we bake that together with what I just mentioned about lower funding costs in dollars, potentially a weaker dollar, then overall that should help some of the countries around the world where demand is still strong and likely to remain firm and potentially even rise in the coming years.
So I guess, putting this all together with everything that we've talked about, and thank you so much for your time, I guess how would you summarize your outlook for oil prices to close out 2024 and going into 2025?
Very murky, simply because we have the Chinese slowdown right now. We have some data on manufacturing both in the US and Europe, potentially pointing to a slowdown there as well. So it is going to be quite a potential challenging year we're facing. And I think the only thing we probably is assured is that the low volatility we've seen now for the past couple of years is unlikely to last into next year, where there's so many different tools that will have played its part in setting the price of oil. But generally, I think OPEC will need to stick together, and as long as they do, then I think the downside is potentially limited, simply because they will have to adjust production in order to maintain prices at these levels.
Thank you. So I guess let's squeeze out one more question for you. Is OPEC still relevant in the oil markets?
They are relevant when prices rally, because then it's easy to cut production. When prices are falling, it's much more of a challenge, and that challenge is what they're facing right now. And the question is obviously, with so many producers still having a lot of oil in the tank that they want to increase production with, whether they will stick to their quotas, and that potentially could also be a key focus heading into next year. But for now, they are a force to be reckoned with.
Ole Hansen, Head of Commodities Strategy at Saxo Bank, joining us from Copenhagen, Denmark. Thank you so much for your time. We really appreciate your insights. Thank you.